Well, one of the Fed's more hawkish members, Governor Michelle Bowman, indicated Monday that rate hikes are likely over thanks to progress on lowering inflation, though she did warn that risks remain. Thursday's CPI print will give a crucial read into the Fed's inflation fight. With more, we're joined by Jim Smigiel, who is SEI Chief Investment Officer. Jim, thanks for being here. And, you know, what is CPI? How pivotal is CPI going to be here?
Well, thanks for having me. Certainly all eyes are going to be on it. The Fed is absolutely data dependent. You mentioned Bowman, really thought of as a hawk. So, you know, she was really one of the last kind of holdouts to kind of acquiesce a bit into this pivot, probably a little bit of a strong word for her commentary, but pretty much close to it, that we have reached the end of the tightening cycle. So from here on in, it's going to be accumulation of data. Of course, it's not going to be any one release, which is going to, I think, move the Fed off of their trajectory. But CPI important, PCE important. Everything here on out is going to be another information point for the Fed and for the market, which, of course, you know, right now the Fed and the market are a little bit further apart in terms of how they're viewing rate cuts for 2024.
And Jim, let me just pick up there. I mean, do you think markets are too optimistic here in their interest rate expectations?
We do. We're looking at right now. We ended the year about 160 basis points of cuts priced in. That's come off a little bit into the new year. We're about 140 to 150 cuts priced in. Fed's at 75 basis points. We're definitely more in the Fed's camp than in the market. This idea that we're going to achieve this near perfection landing, and the Fed's going to enact what are really become known as normalization cuts. Not from a stimulus standpoint, but just because they're able to, that there's enough of an air pocket between where inflation is today and where Fed funds are that they can slowly drift this down. We think that's a little too Pollyannish. And our expectation are, sure, we've seen the trends of inflation. They are off the highs. However, services, wages, and quite frankly, with what's going on with shipping right now, we may even have a bit of a revival of goods inflation. So we think the Fed is going to take much more of a slower go approach.
You know, Jim, just using sort of anecdotal evidence, you are among many, many people who we've spoken to in the past few weeks who have been saying this same thing. Why is the market still pricing in as many cuts as it is when seemingly everybody we talk to doesn't think they're going to cut that many times?
I think that's a great point, Julie. And to be honest, it's the same thing as it's a repeat of 2023. If we'll recall, if we wind the clock back 12 months, we were in the same position. The market had Fed cuts priced in. I think myself and a lot of other talking heads out there were saying the same things, that we don't see cuts in 2023. We didn't get cuts in 23. We actually saw additional hikes. And the market didn't care. The market rallied 20% based on a lot of other factors, such as the AI fever that you were talking about earlier. So, you know, I think it's a great question, which is what does the bond market see? And there's a few different ways to look at it. The bond market, quite frankly, might be a bit more negative than the equity markets, not necessarily expecting this soft landing. The bond market might be looking at it from a stimulus standpoint to expect a little bit of a downdraft in economic activity that really equity investors don't seem to be pricing in at this point in time. There's a lag to monetary policy. There's a broader lag to monetary policy this cycle, just given where we started from, with corporate balance sheets in great shape, with debt termed out. I think the bond market has a little bit more of a negative overtones to it, and are thinking that, you know what, this isn't going to be a perfect kind of scenario, and there could be bumps along the way. Not mentioning the fact that from a supply and demand perspective, quite frankly, you know, we have a lot of debt we have to float in 2024. So I think there's a little more of this dual personality. Equity markets are very, very positive. I think the bond market, you're seeing that skepticism, and the cuts that are priced in are actually stimulus cuts and not actually this idea of normalization cuts, which is allowing these valuations in equity markets to be maintained at these levels.
And Jim, you know, investors, of course, pay attention to the Fed. They also pay attention to corporate earnings. Earnings season is now upon us here. What are your expectations for this earnings season, Jim? And do you think could it be a positive catalyst for the market?
It's a great point, and it gets back to some of the earlier comments that we're talking about. Double digits earnings growth priced in for 2024. Honestly, we're going to take the under on that one. I think there's a lot of early warnings that are coming, that we're seeing from economic growth, from small businesses, that leaves us, quite frankly, a bit skeptical that we're going to be able to reach these kind of lofty levels that we see baked in the cake at this point. And given that they are baked in, that's also going to give you a sense as to, what we see from an equity market perspective, very much sideways kind of range-bound trading this year. And I wouldn't say we're outright negative, calling for a downdraft, although it wouldn't surprise us to see that certainly in the second half of the year. But we're certainly not expecting anything resembling what we saw over the prior 12 months.
Jim, as I mentioned when I was talking about what's going on with markets today, we've got financials under pressure. Banks are reporting later in this week. I know that financials is an area that you are focused on right now. Is it an area that you would be adding to ahead of earnings?
I think it is. It's really, if you look at it from a valuation perspective, these are just very, very attractive levels to be looking at financials and adding them to your portfolio, whether it's broad-based financials or banks in particular. Forward PEs are really not challenging at all, and that's on an absolute basis. If we look at that relative to some other sectors or even to the broader market, they are, quite frankly, on sale. So, we're not looking at adding to financials with any kind of 3-month or 6-month target. For long-term investors, this is a good opportunity to pick up very, very high-quality companies at extremely reasonable valuations.
And so, Jim, so that's what you find attractive. What don't you find attractive? Which sectors would you avoid here?
Yeah, I think the biggest thing from our perspective this year is we really like diversification, and therefore what we find not terribly attractive is concentration, is the opposite of that. So, along the lines of probably everyone talking about Fed cuts this year, probably the other topic that everyone's talking about is the Magnificent Seven, the dominance from a market cap perspective. If you're an index level investor, you're getting a 30+% of your investments are in just 7 names. That's something that we would like to fade. There's a lot of optimism, a lot of the points that we've already discussed, priced into the Magnificent Seven at this point. These are great companies. There's no doubt about it. They can continue to scale. There's no doubt about that. It's just a little too much idiosyncratic risk. We've seen that flare up in weeks past with the Apple Watch. We still have antitrust suits going on relative to Google. We would rather diversify that idiosyncratic risk and have a little bit more of that kind of diversified exposure. So that's kind of what we're fading. What we don't like is highly concentrated equity positions in 2024.
Jim, thanks so much for joining the show today. Appreciate the time and the insight.
Thanks for having me.